First of all, let's summarize the last lecture which I delivered regarding the leverage analysis. Before coming on the chapter, let's talk about leverage. In last session, we covered the topic leverage analysis. In leverage, we done three types of the leverage: operating leverage, financial leverage, and combined leverage. After doing some numerical in leverage, we have discussed you about the EPS. EPS was the earning per share. We had to calculate operating leverage, financial leverage, and combined leverage. But at last, in some numericals, I also calculated EPS for you so that there should be a link between leverage and EBIT EPS analysis. So leverage tells you the effect of financing pattern. It means if you take a loan for a shorter period, what was the effect? Normally the effect was on the EBIT. And whenever the organization collected fund for establishment of the organization, the effect was on EPS. Now let's come on the EBIT EPS. There may be different firms which are operating under similar condition and having same level of EBIT and are alike in all respect except the pattern of financing. Whether these firms will have same return for the shareholders. This analysis of the effect of different pattern of financing on the level of return available to the shareholders under different assumptions of EBIT is known as EBIT EPS analysis. So in nutshell, you can understand in this way that suppose there is an organization and it needs rupees 50 lakh. Now it has different option. It may collect rupees 50 lakh by issue of equity. Option number 1. Option number 2, it may collect rupees 50 lakh by issue of debenture. Option number 3, it may collect rupees 50 lakh by bank loan. Option number 4, it may collect 50 lakh rupees by preference share. Option number 5, it may collect 25 lakh by equity, 25 lakh by debt. Another option, it may be 10 lakh by equity, 10 lakh by debt, 10 lakh by preference share, and remaining part by bank loan. So there are number of alternatives available in front of the organization. Now organization has to take a decision what should be the pattern of financing. Now to conclude it, or you can say to select the best alternative, we have to do EBIT EPS analysis. For example, a firm which was collecting rupees 50 lakh by different sources of finance has fixed EBIT. Suppose its EBIT of the firm is rupees 20 lakh and it is fixed. Now you have to check which alternative is best for you, and the best option will be the option where firm is generating maximum EPS. If option number 2 is generating maximum EPS, then it will be better. And if option number 5 is generating maximum EPS, then it will be the best option. So by the help of EBIT EPS, we can check which financing alternative is best for the organization. In some cases, EBIT is fixed. In some cases, EBIT may be changes. Now, let's understand about the financial break-even level. In case of EBIT, level of a firm is just sufficient to cover the fixed financial charges. Then such level of EBIT is known as financial break-even level. In other words, the financial break-even level is such a level of EBIT at which only the fixed financial charges of firm are covered and consequently the EPS is 0. So, financial break-even level, financial break-even EBIT is equal to interest charges plus preference dividend into 1 minus tax rate. So, what is the meaning of financial break-even? Simply a level where organization is able to recover fixed financial charges is called financial break-even level. For example, a firm is earning an EBIT of rupees 5 lakh and at initial stage when the organization had to start its business, it created its capital structure in this way so that it has to pay interest charges as rupees 1 lakh. So, financial break-even level is rupees 1 lakh because it is a level where organization is able to cover fixed financial charges only. So I think it should be clear to all of you. Now, third point is indifference point. The indifference level of EBIT is 1, at which the EPS under 2 or more capital structures are same. In other words, such a level of EBIT at which the firm has 2 or more financial plans resulting in same level of EPS is known as indifference level of EBIT. What is the meaning of indifference? Indifference means EBIT will be same. Indifference level of EBIT is 1 at which EPS under 2 or more capital structures are same. It means, suppose we have 2 options. The firm had to collect rupees 50 lakh. Now the firm had 2 options. It may go to collect rupees 50 lakh by issue of equity shares, and the firm also had the option to collect rupees 50 lakh by issue of debenture. Now, if you had to calculate indifference level of EBIT, then you had to set and you had to find out a point of EBIT where EPS will be same. It means if we collect rupees 50 lakh by issue of equity, then EPS will be same. And if we collect rupees 50 lakh by issue of debenture, then EPS will be same. Then where it will be same? So when we have to find out an level of EBIT, a one level of EBIT will give you same EPS even you collect by issue of equity or you collect by issue of debenture. So this point is indifference point. Now in today's session there are three basic points which I have discussed with you, and after that we will come on the numerical part. First EBIT EPS, second financial break-even, and third is indifference point. In this chapter we have two types of numerical. Number one on the basis of EBIT EPS analysis, and after that we have some numericals on indifference point. So let's start EBIT EPS analysis. This is numerical number one. Problem based on EBIT EPS analysis. This is a problem. Bhaskar Manufacture Limited has equity share capital of rupees 5 lakh, face value of rupees 100 each. To meet the expenditure of an expansion program, the company wishes to raise rupees 3 lakh and is having following four alternative sources to raise the funds. I am repeating again. There is a company and the name of the company is Bhaskar Manufacturer. It has share capital of rupees 5 lakh and it needs rupees 3 lakh rupees for an expansion program. And whenever it has to expand the business, it has some option. Option number one or plan number A, to have full money from the issue of equity share. It means it may be collected by issue of equity share, plan A. Plan B, to have rupees 1 lakh from equity and rupees 2 lakh from borrowing at the rate of 10% per annum. This is plan B. Plan C, full money from the borrowing at the rate of 10%. Plan C. And after that, plan D, rupees 1 lakh by equity and rupees 2 lakh from 8% preference share. Plan D. Now, the company is having present EBIT of rupees 1,50,000. The corporate tax rate is 30%. Select a suitable plan out of the above four plans to raise the required fund. I think problem is clear. I am repeating again. In this problem, Bhaskar Manufacture Limited had rupees 5 lakh equity capital and it needs rupees 3 lakh, and whenever it had to collect rupees 3 lakh, it had four plans. Plan A, it collected rupees 3 lakh by issue of equity. Plan B, it collected by equity and debenture and borrowing at the rate of 10%. In plan C, it collected all money from borrowing at the rate of 10%. Plan D, rupees 1 lakh by equity and rupees 2 lakh from preferential. There are four options. Now, present EBIT is rupees 1,50,000, tax rate 30%, and you have to suggest a suitable plan to the organization. Now to solve the problem, let's start. This is solution. Now, first of all, I draw this format before starting the problem so that the wastage of time can be reduced and we may focus on solution of the problem. So first of all, determination of suitable plan for raising fund, you have to write down here, and after that particulars, plan A, plan B, plan C and plan D. Now, first is issue of equity share. Equity shares. Full money from the issue of equity share plan में. Now 3 lakh. Second, 1 lakh by equity and 1 lakh by debt. Borrowings. You can say this is debt at the rate of 10%. And plan B, in plan B you are having 1 lakh by issue of equity and 2 lakh by debt. Now, plan C, full money from borrowing. Plan C, 3 lakh from borrowing. Now plan D, 1 lakh by equity and 2 lakh from preference share. 1 lakh by equity and here preference share 8% preference share. Two lakh. Now this is a creation of plans. Now I think it should be clear that plan according to plan A, firm has the option to collect rupees 3 lakh by issue of equity. So I am writing here in front of equity. In plan B, you had an option to collect rupees 1 lakh by equity and rupees 2 lakh by debt. So I am adding 2 lakh in front of debt. In plan C, you had to collect rupees 3 lakh by debt at the rate of 10%. So I am adding amount of rupees 3 lakh in front of debt. In option number 4, यानी कि plan D. In plan D, you had to collect rupees 1 lakh by equity, so I am writing 1 lakh in front of equity, and after that rupees 2 lakh by preference share, so I am writing in front of preference share. Now it's clear. After that, we have to follow a format. Format is simple. First of all, you have to write down EBIT, then less interest. Resultant figure is EBT less tax. That's EAT less preference share. Preference dividend. Earning available to equity holders. Now, number of equity shares. Number of equity shares outstanding. Number of equity shares outstanding. क्या बता रहे थे? Number of equity shares outstanding. Now, if this is A and this is B, then EPS is equal to A by B. EPS is equal to A by B. So, this is the format, and we will use this format again and again. In every problem, we will use this format. Now, EBIT is rupees 1,50,000 given in the question. So we will write 1,50,000. In all the cases, this is 1,50,000. So I paste it. Now, interest. In plan A, as you know, that you collected rupees 3 lakh by issue of equity shares. So, interest burden is 0 here. In option number 2, because you collected rupees 2 lakh by issue of or you by debt, and the rate of interest on the debt is 10%, it means interest burden will be 20,000 rupees. Now in option number 3, interest burden is rupees 30,000. In option number 4, again, because debt is 0, so interest will be nil. Now EBT will be 1,50,000 minus 0. It will be 1,50,000, 1,30,000, 1,20,000, 1,50,000. So this is EBT. Now deduct tax. Let's see what is the rate of tax. This is given the corporate tax rate. The corporate tax rate is 30%. So tax is 30% and tax is chargeable on the EBT, because here EBT is 1,50,000, so tax will be 30% of 1,50,000. It will be 45,000. It will be 39,000. It will be 36,000. It will be 45,000. Now deduct the amount of tax from 150. Now it will be 105. It will be 91,000. It is 84,105. 000. Now less preference dividend. Now first of all check what is the amount of preference dividend in plan A. If we see the plan A, then it's very much clear that we collected rupees 3 lakh by issue of equity. We never use preference share in plan A, so preference dividend will be nil. In plan number 2, we never use preference shares to collect the funds, so liability will be nil. In plan 3, plan C, again we never take the help of preference share, so here liability will be nil. Now come on plan D. If we see plan D, it's clear that we collected rupees 2 lakh by 8% preference shares. It means we have to pay preference dividend at the rate of 8%. 8% of 2 lakh is 16,000. Now earning available to equity holder will be 105,000. Here 91,000. Here 84,000. Here we have 89,000. So this is earning available to equity holders. Now, number of equity share outstanding, old plus new, old plus new. It means if we are taking the case of plan A, first of all, we have to check that earlier how much equity shares has been floated in the market by the organization. If we see the question again, then it's very much clear that Bhaskar Manufacture Limited has equity share capital of rupees 5 lakh, face value of rupees 100. It means 5 lakh divided by 100. It means 5,000 shares has been floated in the market already. It means already firm had floated 5 lakh equity shares, 5,000 equity shares of face value rupees 5 lakh. It means 5,000 plus 3,000. 5,000 plus 3,000 is equal to 8,000. In second case, it's very much clear. We are receiving rupees 1 lakh. It means we had to issue 1,000 equity share because face value of share is rupees 100. It means to collect rupees 1 lakh, we had to issue 1,000 equity shares. So here, old one was 5,000 plus 1,000 new is equal to 6,000. Here, it's very much clear that we never used equity shares for collection of rupees 3 lakh in plan C. So here 5,000 plus 0 is equal to 5,000. In plan D again 5,000 plus 1,000 is equal to 6,000. Now, last one is EPS. As it's clear that you have to divide 1 lakh 5,000 divide by 8,000. Now, let's take the help of calculator. One zero five triple zero divided by 8,000. This is 13.125. Now here 91,000 divided by 6,000 divided by 6,000, 15.16. 84,000 divided by 5, 16.8. 89,000 divided by 6. 89 divided by 6, 14.8. Now, I think it's very much clear that 16.8 is the highest EPS. So, we will prefer to get rupees 3 lakh by debt. So, in this problem, when organization collects rupees 3 lakh by issue of debenture or by debt, then it could maximize its EPS. So it is preferable that organizations should collect the funds by issue of debt. I think problem is clear and solution is also clear to all of you. Now let's come on some another problems. This is problem number 2. A firm requires total capital funds of rupees 25 lakh and has two options, all equity and half equity and half debt. The equity shares can be currently issued at rupees 100 per share. Expected EBIT of the company is rupees 2,50,000 with tax rate of 40%. Find out EPS under both the conditions. Now this is a problem. A firm requires total capital fund of rupees 25 lakh. Let's start plan A, rupees 25 lakh by all equity, 25 lakh by equity. Plan second, half equity, it means 12 lakh 50,000 by equity and 12 lakh 50,000 by debt. %15 debt. So this is a financial plan. Now we have to check which is more preferable for the organization. So first of all, you have to write down EBIT here. EBIT is 2,50,000. Again here 2,50,000. Let's take the help last question, because there is no need to write down same thing again and again. Now, this is a format which you have to follow in all the questions. So first of all, EBIT, after that you have to deduct interest. In option number 1, because you are getting rupees 25 lakh by issue of equity share, so here interest is nil, and here you are getting 12 lakh 50,000 by 15% debt. It means 15% of 1250, it will be 1875. 187500. This is the interest. Now here, this is 2,50,000. Here we have 62500. Now tax. Tax is 40% and it is chargeable on EBT. So it will be 1 lakh. If you deduct, it will be 1 lakh 50,000. Again, we have to charge tax on 62500. It will be 25,000, and here resultant figure will be 37,500. Now preference dividend is nil in both the cases because we never take the help of preference shares in collection of funds. Now this is 1 lakh 50 and 37,500. Now number of equity shares. Here it is given a firm requires total capital fund of rupees 25 lakh and has two options, all equity and half equity. Equity shares can be currently issued at rupees 100. It means company doesn't have any previous record of equity shares. It means old will be 0 and we will use only new share. New will be 25 lakh divided by 100 will be 25,000 equity shares. Here 12,500. Now 150 divided by 25, that is 6. 37,500 divided by 12,500, it is 3. Now let's check problem again. calculations are accurate or not. Let's take the help of calculator. First of all, 1250 into 15%. 187500. Then EBT minus 62500, tax 25, 37500, 250, 250 minus 150. 250 minus 150 by 25, 6. Calculation is correct, and EPS is greater in case of plan A. So it is preferable that if organization want to increase its EPS, then it should go with plan A. Next question. AB Limited needs rupees 10 lakh for expansion. The expansion is expected to yield an annual EBIT of rupees 1,60,000. 10 lakh rupees required for expansion and EBIT will be 160. Choosing a financial plan, AB Limited has an objective of maximizing earning per share. It is considering the possibility of issuing equity shares and raising debt of rupees 1 lakh or rupees 4 lakh or rupees 6 lakh. Again I am repeating, company needs rupees 10 lakh. It is considering the possibility of issuing equity share and raising debt of rupees 1 lakh or 4 lakh or 6 lakh. It means company will collect rupees 10 lakh by plan A, where raising debt of rupees 1 lakh and remaining by equity. In plan 2, 4 lakh by raising debt and remaining by equity, and in plan C, raising rupees 6 lakh by debt and remaining by equity. After that, the current market price per share is rupees 25 and is expected to drop to rupees 20 if the funds are borrowed in excess of rupees 5 lakh. Okay, it means if you are borrowing funds in excess of rupees 5 lakh, then share price will fall down. Funds can be borrowed at the rates indicated below up to rupees 1 lakh at 8%, over rupees 1 lakh up to 5 lakh at 12%, over rupees 5 lakh at 18%. Assume a tax rate of 50%. Determine the EPS for three financial alternatives. So there are three plans. So first of all, I am deleting plan 4. Now, first of all, equity and debt. Here, EBIT. First of all, let's prepare format. This is a format which I pasted here because there is no need to write down the same format again and again. It's waste our time. Now, first one is you have to read this problem very carefully. It's a toughest problem. It is considering the possibility of issuing equity shares and raising debt of rupees 1 lakh or 4 lakh or 6 lakh. 1 lakh, 4 lakh or 6 lakh. Remaining is equity. 9 lakh, 6 lakh and 4 lakh. EBIT. It is given in the question that annual EBIT of rupees 1,60,000. 1,60,000, 1,60,000, 1,60,000. Now, interest. It is given that if funds are borrowed in excess, if borrow up to rupees 1 lakh, at the rate of 8%, rupees 4 lakh, at 8%. Now, rupees 4 lakh. It is given in the question that 4 lakh at 12%, at 12%. Now 6 lakh at the rate of 18%. Now let's write down the adjustment of equity as well. It is given in the question that the current market price is rupees 25 and is expected to drop to rupees 20 if funds are borrowed in excess of rupees 5 lakh. It means if borrowings exceed rupees 5 lakh, then price will be rupees 20. At rupees 20 each. At rupees 25 each. At rupees 25 each. Now, let's start. Before starting, I want to clear up one thing again. This question can be solved with two assumptions. Assumption number one, that when we are collecting rupees 1 lakh by debt, the rate of interest at rupees 1 lakh will be charged at the rate of 8%. If we collect rupees 4 lakh, then we will give interest at the 12% on whole the amount. Whole means whole 4 lakh rupees. And whenever we are collecting rupees 6 lakh at the rate of 18%, then amount which we have to pay will be 18% on 6 lakh rupees. This is a assumption number one. We can solve this problem with making this assumption, and we can solve this problem with another assumption as well. Another assumption says collect rupees 1 lakh at the rate of 8% and remaining 3 lakh collect at the rate of 12%. On the same time, whenever you are collecting rupees 6 lakh, collect rupees 1 lakh at 8%, collect rupees 3 lakh at 12%, and remaining 2 lakh collect at 6 at the rate of 18%. So we will solve this problem with both the assumptions. First of all, we are assuming that if we are taking 1 lakh debt, we have to pay rupees 8,000 as interest. If we are collecting rupees 4 lakh, we will have to pay 48,000, and if we are collecting 6 lakh, we will have to pay 1 lakh 8,000. After that, we will solve the problem with different assumption. Now, first of all, interest. Interest is 8,000. Now it will be 1,52,000. Here 48,000. 112,000. Here 108. 52. Less tax. Rate of tax is 50%. It means this is 76. 76. 56. 56. 26. 26. This is earning after tax. Preference dividend is nil in all the cases. Earning available to equity holders, because deduction is nil, so amount will be same. Now, number of equity shares outstanding. AB Limited needs rupees 10 lakh for expansion. Expansion is expected to yield an annual EBIT of 1,60,000. It is considering a possibility of issuing equity share and raising debt. It means information about the old shares is not given in the question. So we are assuming that old is nil. Now new 9 lakh rupees at rupees 25 each. It will be 36,000. Now 6 lakh 25 each, 24,000. Now 4 lakh by 20, 20,000. Now take the help of calculator. $76,000 divided by 36,000 is equal to 2.11. 56 by 24, 2.33. 26 by 20, 1.3. So here it's clear that plan B is better. Now let's do the problem with assumption number 2. solution with another assumption. Here picture is same. Now let's write down first of all assumption. Assumption is that when a firm is getting rupees 1 lakh, the firm has to pay interest at the rate of 8%. Over 1 lakh to 5 lakh at the rate of 12%. It means 1 lakh by 8% and 3 lakh at the rate of 12%. 1 lakh at the rate of 8% and 3 lakh at the rate of 12%. Now here 1 lakh at the rate of 8%, 3 lakh at the rate of 12% and 2 lakh at the rate of 18%. So this is the assumption number 2. If you have to solve this problem with this assumption, that calculation will be different. Let's do it. We write down EBIT 160, 160, 160 in all three cases. Now, interest 1 lakh at the rate of 8% means 8,000. 1 lakh at the rate of 8% means 8,000 plus 3 lakh at the rate of 12%. 36,000 is equal to 44,000. Now 8,000 plus 36,000 plus 36,000. Now EBIT will be 152 116. Now, EBIT is 152, 116 and 80. Tax rate is 50%, 76 and 76. 116, 58 and 58. 80, 40 and 40. Preference dividend nil. Old plus new shares are same. Now by calculator 76 by 36, 2.11, 58 by 24, 2.41, 2.41, 40 by 22. Again, plan B is better, but there is a change in calculation. So now it's on you which method or which assumption you want to follow. I have solved the problem with both the assumptions. Now let's start another problem of EBIT EPS analysis. This is a company requires capital fund of rupees 5 crore and has two options to raise the amount by issue of 15% debenture and second to issue equity shares at a rate of rupees 20 per share. It already has 40 lakh equity share issued and debt financing at a rate of 12%. Find out expected EPS under both financial option at the given EBIT level of rupees 2 crore and 7.5 crore. There are two plans, plan A and plan B. And we have to solve this problem two times. First, we will write EBIT 2 crore and after that we will write EBIT 7.5 crore. Now let's read again. A company requires capital fund of rupees 5 crore. Option number 1, to raise the amount by issue of 15% debenture. So first of all, new one. We are talking about new infrastructure. Equity and 15% debentures. ₹5 crore 5 crore debenture. Equity at the rate of 20 per share. It already has 40 lakh equity shares issued and debt financing of rupees 6 crore at the rate of 12%. Now, again, it depends on you that you would like to include debt financing charges in the calculation, because there is no need to include this calculation, because we have to take the decision, and this is actually the cost which is incurring in both the alternative. So if we are adding and if we are not adding, results will be same, although there will be a slight change in calculation. So we are assuming that because debt charges will be the part of both the plan, so there is no need to include but if you are not including it, you have to write down that in assumption that because fixed financial charges are the part of plan A and plan B, so there is no relevancy to take or to include it in the calculation. And if you want to include it, then there is no need to make an assumption, and simply you can add the amount. If you are adding it, then no problem. If you are not adding, then there is no problem, but you have to clearly mention it. Now, because there's some another type of problem, so I think I should include, because if you are not including, then it is very easy for you to delete it, and if you want to include it, it will be problematic for you. So I am including it first of all, then see other things. EBIT, first of all, write down EBIT. EBIT, it's 2 crore and 7.5 crore. Less interest. Now again, I am using the format of last question. interest. Now it may be old plus new and it may be new only. I am including old plus new. Old plus new. Old is 40 lakh equity shares, already has 40 lakh equity share and debt financing of rupees 6 crore at 12%. It means 72 lakh. 72 lakh. Old plus new. In new, you are having 15% debenture. Option number 1, 50% equity to 20%. In plan B, this was the plan. 5 lakh by issue of equity or 5 lakh by 5 crore. This is the plan. Now, fixed financial charges of organization is 72 lakh plus 5 crore at the rate of 15%, it will be 75. Just a minute, I have to take the help of calculator. 6 crore into 12%, 72 lakh, good, plus 75 lakh. Here 72 lakh, again 72 lakh plus 75 lakh. I think it's clear to all of you. Interest old plus new. It was given in the question that the organization has collected rupees 6 crore at the rate of 12%. So old interest is 72 lakh rupees and right now the organization has collected rupees 5 crore at the rate of 15%. So new interest will be 75 lakh. If we talk about the plan B, old interest is 72 lakh, but because in plan B you are not receiving anything by the way of the debenture, so there is no need to pay any type of interest, so interest will be 72 lakh. Same plan A, plan B here. Now 72 plus 75 is equal to 147. It will be 353. It will be 2 crore minus 72 lakh this is 2 crore, this is 2 crore. Now 53 lakh, EBIT was rupees 2 lakh, 2 crore, 2 crore, 7.5 crore, 7.5 crore. Now deduct interest from EBIT. If we deduct 147 lakhs from 2 crore, it will be 53 lakh. And if we deduct 72 lakh from 2 crore, it will be 128 triple zero. Same 147 minus 750. It will be 603. 678. Now tax. Tax rate is 50%. 53 means 2650. I'm taking the help of calculator. 53 lakhs into 50% is 2650 triple zero. Now here 128 644 603 00 301 01 50. Again here 678 339. Now EAT if we deduct, the amount will be same because it's a tax rate is 50%. Now, preference dividend is nil. Earning available to equity holder will be same. Number of equity shares, old plus new. It is given in the question that already has 40 lakh equity shares. 40 lakh equity shares, and here 40 lakhs 40 lakh plus new will be nil. Here old plus new, 40 lakh plus new. New will be 5 crore divided by 20. It means 5 crore by 20 will be 25 lakh shares. 40 lakh plus 25 lakh, 25 lakhs. Is equal to 65 lakh. Same calculation is here. Now EPS is equal to A by B. 26 lakh 50 divided by 40. Point 6625. 6625. Point 984. 0.984. So it is preferable that if you are going to collect rupees 5 crore, then it is preferable that you should take the help of equity share. Plan A. Now, in another condition where EBIT is 750, then what is the scenario? Now let's check it. 301,500 divided by 40 lakh 30150. Now here this is 7.53, 7.53. Three three nine here it is 5.21. 5.21. So if we follow the same pattern in case of second situation where EBIT is 7.5 crore, then result is different. Here calculation suggests that organization has to collect the fund by issue of debentures, because in that case EPS of the firm is better in comparison to last one.